Introduction. Let me ask you a simple question. How much money do you need to achieve financial freedom? Most people would probably answer $1 million, maybe 2 million, or even more. That's what we've been told for decades. Work hard, save aggressively, invest for the long term, and wait until retirement before you finally enjoy life. But after years of studying the US financial markets and working with people who are building financial independence, I've come to realize something fascinating. Many people don't actually need the massive fortune they think they do. What they really need isn't a huge number sitting in a bank account. What they need is a reliable stream of income that arrives every month, whether they're still working or not. And that's a huge difference. Because when you think about it, you don't pay your electric bill, your mortgage, your groceries, your insurance premiums, or your family vacations with the paper value of your investment portfolio. You pay for them with cash flow. For many years, conventional retirement advice has been straightforward. Accumulate millions of dollars, then withdraw about 4% per year so your savings can last throughout retirement. That strategy has helped millions of people plan for the future. But it's also made financial freedom feel out of reach for many others. They look at the idea of needing several $1 million and conclude they'll have to work another 20 or 30 years before they can retire. But today's financial markets are very different from what they were 20 or 30 years ago. The rise of income-focused ETFs, especially those using covered call strategies, has created a completely different approach. Instead of relying solely on long-term price appreciation, investors can begin building a portfolio that generates monthly income while they're still accumulating wealth. Now, I want to make one thing absolutely clear. This does not mean you'll become wealthy overnight, and it certainly isn't a get-rich-quick formula. Anyone who promises that is setting unrealistic expectations about investing. What I want to share with you is a different way of thinking. Imagine two investors who each own a portfolio worth $500,000. The first investor focuses only on investments yielding around 2% annually. The second builds a portfolio specifically designed to generate higher cash flow while still managing risk responsibly. Both investors have exactly the same amount of money, but their day-to-day lives could look completely different. One may still need to sell investments whenever cash is needed. The other may receive enough monthly income to cover most of their living expenses without constantly selling the assets they've spent years building. That's exactly why more and more investors in the United States are shifting their focus from simply growing wealth to building reliable cash flow. However, this is also where many investors make a costly mistake. They see an ETF advertising a 20%, 30%, or even nearly 40% annual yield and immediately assume it's the perfect investment. In reality, it's not that simple. One principle I always emphasize is this: the higher the yield, the more questions you should ask, not fewer. A high income stream doesn't mean much if your portfolio is losing value faster than the income it generates. The real question isn't just how much cash you receive each month. It's whether 5 or 10 years from now, your portfolio will still be capable of producing that income. That's why today's video isn't simply about the ETFs with the highest yields. Instead, we're going to explore how experienced income investors in the United States evaluate income-producing ETFs. They don't focus only on dividend yield. They also look at total return, capital preservation, diversification, and how different ETFs can work together to create a portfolio that delivers dependable income while still providing long-term growth potential. Because financial freedom isn't about earning the highest return in a single year. It's about building a system that can generate sustainable income through every stage of the economic cycle. If you're looking for a practical path to gradually reduce your dependence on a monthly paycheck, and if you want to understand why so many American investors are shifting toward cash flow investing instead of focusing exclusively on capital appreciation, then stay with me until the end of this video. I'll walk you through 5 categories of ETFs that income investors are paying the closest attention to today, explain how to evaluate them from an economist's perspective, and, most importantly, show you how to build a portfolio that can move you closer to financial freedom while maintaining the right balance between income, growth, and capital preservation. One thing I've realized after years of working with investors across the United States is this: most people don't fail because they picked the wrong stock. They fail because they misunderstand the true purpose of investing. When we're young, we often think investing is all about chasing the biggest possible returns. We're drawn to stories about a stock that went up 5-fold, a cryptocurrency that skyrocketed 10 times in value, or an investment that delivered hundreds of percent in gains in just a short period of time. But as the years go by, especially once we reach our 50s or 60s, the question begins to change. It's no longer, how can I make the most money? Instead, it becomes, how can I make my money work for me every single month? That's exactly why income investing has become increasingly popular in the United States. Interestingly, many people believe rental real estate is the only reliable way to generate cash flow. But today's stock market offers investment tools that can also provide consistent income when they're used wisely. One of those tools is the covered call ETF. In the simplest terms, these funds don't just own stocks like traditional ETFs. They also generate additional income by selling covered call options. That extra income allows many of these ETFs to pay significantly higher monthly distributions than traditional stock ETFs. However, this is also where many new investors fall into a dangerous trap. They open a data screen, see an ETF with a 30% yield, and immediately assume it's the best investment available. If investing were really that simple, everyone on Wall Street would have retired years ago. The reality is far more complicated. In economics, there's no such thing as a free lunch. Whenever you see an investment offering exceptionally high returns, the first question shouldn't be, how much can I make? It should be, what am I giving up in return? That's the mindset professional investors always maintain. An ETF may pay an exceptionally high distribution, but if the value of the fund continues to decline, you may simply be getting your own principal back over time. That's not sustainable income. That's your capital being gradually returned to you. That's why, whenever I evaluate a covered call ETF, I focus on three things first. First, the cash flow the fund generates. Second, its total return, including both distributions and price appreciation. And third, its ability to preserve capital over the long run. Those three factors will always matter more than an eye-catching yield displayed on a screen. That's also why so many American investors build the foundation of their portfolios around funds tied to the S&P 500. The S&P 500 represents 500 of the largest publicly traded companies in the United States. These are businesses that have survived recessions, financial crises, changing interest rate environments, and multiple economic cycles. When a covered call ETF is built on top of the S&P 500, investors can benefit from the strength of America's leading companies while generating additional income through its options strategy. It's a balanced combination of growth and cash flow. Once that solid foundation is in place, many investors begin looking toward higher growth opportunities. That's where the Nasdaq 100 comes in. If the S&P 500 represents the broader American economy, the Nasdaq is home to many of the world's most influential technology companies: Apple, Microsoft, Amazon, Meta, Alphabet, NVIDIA. These are companies that have transformed the way people live and work over the past 2 decades. What's interesting is that even investors who want exposure to high-growth technology often prefer receiving monthly income instead of relying solely on stock price appreciation. That's one of the main reasons covered call ETFs based on the Nasdaq have become increasingly popular. They allow investors to participate in the continued growth of the technology sector while generating a steadier stream of income. Of course, no discussion of today's financial markets would be complete without talking about one trend that's reshaping nearly every industry. Artificial intelligence. AI is no longer a vision of the future. It's happening right now. From healthcare and banking to education and manufacturing, virtually every industry is looking for ways to use AI to improve productivity and efficiency. That means many AI-related businesses may continue growing for years to come. But high growth almost always comes with high volatility. That's simply how markets work. For that reason, instead of putting all their money into a handful of individual AI stocks, many investors choose ETFs to spread their risk. And when those ETFs also incorporate a covered call strategy, investors can participate in the AI revolution while generating recurring income at the same time. It's a much more disciplined approach than simply chasing whichever stock happens to be the hottest at the moment. Another area that generates endless debate is Bitcoin. Some believe Bitcoin will eventually become digital gold. Others see it as nothing more than a speculative asset. Whichever side you take, one fact is difficult to deny: Bitcoin remains one of the most volatile assets in the financial markets. Ironically, that volatility can also create opportunities for covered call strategies to generate higher income. Even so, I always tell my clients that neither Bitcoin nor AI should make up an entire investment portfolio. They should be the seasoning, not the main course. A healthy portfolio is built on balance. That's why diversification remains one of the most important principles in investing. Even Warren Buffett has repeatedly emphasized that protecting your capital is just as important as growing it. A portfolio concentrated in a single sector may perform exceptionally well one year, but it may also keep you awake at night the next. On the other hand, by thoughtfully allocating your investments across the S&P 500, the Nasdaq, AI, Bitcoin, and international ETFs, you spread your risk much more effectively. No investment stays at the top forever, but no single downturn has to devastate your entire portfolio if you've prepared in advance. That's what successful investors are really striving
Before
for.
you could see the results.
There's one more principle
If you
I'd like
start
to leave you
today,
with.
your future
Never
self
spend
will
every
thank you.
dollar of income
But
your
if you keep
portfolio
waiting for the
generates.
perfect time,
That may sound
there's a
contradictory.
good chance you'll still
If
be
you're
standing in the
investing for
same place
income,
years from now.
why
Thank you for
wouldn't you
spending
spend
your
all of
time
it?
with me
The
and
answer
watching
lies
all
in
the way
power
to
of
the end.
reinvestment.
If you
Some
found today's
high-yield
discussion
ETFs
valuable
inevitably
and you'd
go
like to
through
keep
periods
learning
of
about
price
investing,
decline,
financial
by reinvesting
freedom,
a portion
and
of your
building lasting
distributions
wealth,
back
be
into
sure
the
to
fund,
like
you're
this
allowing
video
your
and subscribe to
portfolio
the
to
channel so
heal
you
and
don't miss
strengthen
future
itself over
episodes.
time.
Every
As your
week,
share
we'll
count
explore
grows, your
time-tested
future
financial
income grows
principles,
with it.
break
That's
down
the
the
power of
economic trends
compound
that
growth.
matter most,
The force
and learn how to
Albert
make money
Einstein
work for our
famously called
lives
the
instead of
eighth
spending
wonder
our
of the
lives
world.
working for money.
Not because it's
Until next
magic,
time,
but
take
because
care,
so few
keep
people have the
investing in your
patience to let
future,
it work.
and I'll see you in the next
Finally,
video.
the most important thing I want you to remember isn't the name of any particular ETF. Markets will always change. The best performing funds today may not be the leaders 5 or 10 years from now. What doesn't change are the principles of sound investing. Don't chase the highest yield. Instead, seek the right balance between income, growth, and capital preservation. Because the ultimate goal of investing isn't to own the most impressive looking portfolio on a screen. The goal is to build a life where your money works for you, instead of spending your entire life working for your money. One thing I've realized after years of studying the US economy and working with people who have achieved financial independence is this. The biggest difference between them and most people isn't that they earn more money. It's not because they always pick the highest performing investments, and it's certainly not because they've been luckier. What truly sets them apart is that they understand one simple principle. Financial freedom isn't measured by how much money you own. It's measured by how long you can live without having to trade your time for money. Take a moment to think about that. When you wake up each morning, what creates the most stress? It's not that you don't have enough assets on paper. It's knowing that if you stop working for too long, your income stops too. That's why so many people who own beautiful homes, drive expensive cars, or have sizable investment accounts still feel financially anxious, because their wealth isn't producing dependable cash flow. On the other hand, I've met people whose net worth is far more modest, yet they live with remarkable peace of mind. Every month, their investment portfolio generates enough income to cover most of their living expenses. They no longer panic when the market drops a few percentage points in a single day. They no longer wake up feeling like they have no choice but to go to work just to pay the bills. That's what investing is really about. It's not about showing off the portfolio with the highest returns. It's about creating a life with more choices, more time with your family, more opportunities to pursue the things you truly enjoy, and greater peace of mind as you move into the later chapters of your life. Covered call ETFs can be a valuable tool on that journey, but remember, they're only a tool. No ETF can replace sound investment thinking. No strategy can eliminate risk completely, and no investment delivers exceptional returns forever. The goal isn't to find the ETF with the highest yield. The goal is to build a portfolio that matches your own financial goals. If you're still young, you may want to emphasize growth. If you're approaching retirement, steady cash flow may become a higher priority. There isn't one right answer for everyone. There's only the answer that's right for your situation. That's why I always encourage investors to look beyond the attractive yield displayed on the screen. Ask yourself the more important questions. Can this portfolio generate reliable income over the next 10 years? Is it diversified enough to withstand economic downturns? If the market enters a prolonged bear market, Will I have the confidence to stay invested? Those questions will have a much greater impact on your long-term success than any individual ETF ever will. Warren Buffett once said that the stock market is a mechanism for transferring money from the impatient to the patient. I'd like to add one more thought. The market also rewards people who have a clear plan, because when you know exactly why you're investing, you're far less likely to be distracted by sensational headlines, get-rich-quick promises, or short-lived speculative manias. Instead, you'll stay focused on what truly matters, building a system that generates income, protecting your capital, and allowing time and the power of compounding to do the rest. If there's only one thing you remember from today's video, I hope it's this. Don't invest just to become wealthy. Invest to become free. Because money only has real value when it gives you the freedom to choose how you live, the freedom to spend time with the people you love, and the freedom to wake up each morning knowing you're living life on your own terms, not according to the pressure of the next bill that needs to be paid. Thank you so much for watching all the way to the end. If you found today's video helpful, please hit the like button. It really helps the video reach more people who are working toward financial freedom. And don't forget to subscribe and turn on notifications, because in future videos we'll continue exploring new investment trends, passive income strategies, and timeless wealth-building principles that have proven themselves through multiple market cycles. Until next time, remember this. Successful investing isn't about predicting the future perfectly. It's about preparing wisely for whatever the future may bring. I wish you smart investing, unwavering discipline, and steady progress toward the financial freedom you've worked so hard to achieve.